Hello, everyone, and welcome to Leading Indicator, a show by Public.com bringing you insights from the world's best macro minds. I'm your host, Kinsey Grant, and we are here with you today to discuss the concept of liquidity cascading and its impact on markets. Don't forget to like, comment, and subscribe to our YouTube channel for more in-depth interviews that will help you keep up with the latest investment news. Today, we are here with Corey Hoffstein, the CIO of Newfound Research. Corey, welcome to Leading Indicator. How are you?
I'm very well, Kinsey. Thank you for having me.
Of course, I'm excited to have this conversation today. We have some big macro ideas that we have talked about on the show at varying points throughout the last several months here of these ideas that are impacting the way that investors are going about understanding what the future might look like for their portfolios, for their strategies, et cetera. And today we get a really unique opportunity to kind of understand how all of these big macro themes might tie together to create some sort of, double macro idea that impacts markets, certainly. So with that, are you ready to jump in and explain how that works a little bit?
Well, I don't want you to oversell what I'm about to deliver, but we can try.
Sure. I know. I feel confident that you will deliver indeed. So some of these big ideas that I was referencing that we've talked about a ton, on public and just in the general market understanding of what's happening in markets. We're talking Fed policy. We're talking the rise of passive investing. We're talking changes in derivative markets. All of these things might be connected to impact markets sort of all together. Can you break down this idea that there is a correlation between some of these or among some of these larger ideas and larger macro trends? Talk to me a little bit about what that connection might look like and how it impacts markets.
And we're going to do it all in 60 seconds if we can. All of these ideas have been floated around by market participants for the last decade. What is ultimately pushing markets around? Is it central bank policy in a zero interest rate environment? Is it the growth of passive investing? Or is it now the tail wagging the dog with what's happening in derivatives markets? What I saw in March 2020, what was really an exogenous market shock that became an endogenous market event led me to try to figure out for myself what I thought was actually moving markets. And to me, the answer became both simultaneously none of the above and all of the above, that they all in many ways feed into each other and potentially work in concert. So to just give you perhaps a really simple example is over the last decade during a zero interest rate policy environment that the Fed had to enact coming out of the 2008 crisis, it forced investors up the risk curve. In moving up the risk curve, they had to find new and creative ways to try to harvest yield for their portfolios. So it led to a dramatic growth in things like call overwriting programs among both individuals and institutions. But it also led to the adoption of a lot of volatility risk targeting systems, ways in which investors could try to keep more risk, but ultimately take more risk, but ultimately manage it at the same time. And you ended up in this position pre-COVID where a lot of investors were out over their ski tips in the amount of leverage that they were actually using. You get some sort of exogenous shock that impacts the future cash flow of markets, that reprices things lower, and suddenly it sends everyone scrambling for the exit. Now, was that caused by the Fed? Well, you could argue potentially they started the behavioral change among investors. Was it caused by a flight to passive and the way market microstructure now works? Potentially. Or was it caused by all the derivatives that were all of a sudden had to be traded and hedged during the crisis at scale? Again, it's hard to say where these things begin and end, but I think there's a ton of intersection between them.
Yeah, and I think kind of dissecting some of these ideas that if we're talking about the Venn diagram of market impacts, there's certainly a considerable amount of overlap. One that certainly caught my eye or caught my ear is this flight to passive that you mentioned. I think that this idea that investors are treating markets as even sometimes a savings tool has really gained momentum, I would argue, over the years with these tools that make passive investing a little bit easier, retirement planning strategies like 401ks. This passive investing has just really, really gained a lot of steam. So tell me a little bit about how that impacts and I know this is a big question, impacts the economy, but I think there are probably two specific ways in which we could unpack the impact of the rise of passive investing on the economy and on markets. There's, the paper economy, and there's also the physical economy or the real impacts that we're seeing, as participants in the economy. So tell me a little bit about the impacts of this flight to passive that you mentioned.
Absolutely. Well, again, going back to sort of two coincidental events that occurred over the last 15, 20 years, you had the growth of the 401k plan. For younger plan participants, they may not realize that target date funds back in the early 2000s was a sub $10 billion industry. It is now a $3 trillion plus dollar industry. So you have people in a post 2008 environment suddenly not being able to realize a meaningful return on their savings. And so they're pouring all of their savings into a self funded pension, their 401k plan. And that's all put on a target date glide path for the most part due to qualified default regulations that are put into place. And you ultimately have potentially a tighter link between the real economy and the financial economy through the wealth effect, right? That if everyone's savings is no longer in short term T bills and a nice safe savings account at a bank, but is now tied to the market, and that's something that they can look at and access daily through an app on their phone, their spending patterns may all of a sudden be governed by how wealthy they feel. And how wealthy they feel is going to be tied directly to what's happening in the markets. If you're a young investor and you're investing in a 2060, 2070 target date fund that's fluctuating with the volatility of equities, you just might simply not want to spend as much. Or conversely, last year, conservative investors who have the preponderance of their portfolio in bonds, seeing bonds take such a tumble may cause them to pull back from spending. And so all of a sudden, what's happening in the financial economy is having a real reflexive impact on the spending behavior of consumers, which then plays into earnings, which then obviously impacts the price of stocks. And so you can potentially see how this could become reflexive. What I will add is this was a theory that I discussed in my Liquidity Cascades paper in 2020. I think 2022 proved the exact opposite, that you had stocks and bonds fall simultaneously, and that did not stop the consumer at all. Now, maybe there's a lag, who knows, or maybe the consumer has just turned their phone off and isn't looking at their savings. But the risk, I think, is there.
Yeah, it's certainly interesting to really think about the small psychological decision to either look at the number on that phone screen or not. I remember early on in covering markets, I saw a paper at some point that the less you look at it, the better your returns are in the long run. And I've always kind of had that voice in the back of my mind, but it is interesting to consider that it actually impacts, or there could be a material connection between how frequently we look at that number and how dependent on how well that number is doing, if it's doing what we want it to do, right? How that impacts the world around us and the economy around us, I think is really fascinating. And especially as we consider how we have come out of 2020. And I say we as kind of investors, broadly speaking, in those early days of the COVID-19 pandemic, obviously markets took a major hit. Things went kind of bananas after that in various different directions. We had a ton of people entering investing for the first time, with a lot of new stock market investors who picked up one of those apps for the very first time. And it's now coming to the point where we're seeing the real impacts of that, right? These people have not only just kind of played around with what felt like pretend money for a couple of months, it's been years. And 2022 was a tough year, if, kind of on the balance of things. And we're talking about the impact for investors. The S&P finished the year down about 20%. Obviously, 2023, we've seen a little bit of a turnaround. I think we're up close to 17% for the first half of this year, and we're talking right at this halfway point of 2023. I'm curious about how the landscape of this liquidity cascading idea looks differently because of how markets have behaved in the years since 2020, knowing that 2022 was a bit of a rough one. 2023 is looking to shape up maybe a little bit more favorably. Does your thesis change because of the ways that, the S&P 500 goes up and down? Tell me a little bit about that.
A huge part of the core thesis was that the central banks were a contributor to the cycle through their zero interest rate policy, that they were ultimately stepping in at the middle of every crisis. Call it the Fed put, call it whatever you want, but by cutting interest rates and leaving interest rates low, they were ultimately changing the trajectory of investor behavior. When you now talk about a central bank that has been consistent in its language that it was going to hike and did hike, now all of a sudden there is an alternative, right, for investors who maybe don't want to take as much risk. If they're just looking for a nominal level of return, they can put their money Perhaps not in a bank yet. Savings rates aren't there, but they can certainly move them to T-bills or 2-year US Treasuries and find a very meaningful yield on investment. And so that can actually might maybe have a reverse effect here, pull people back away from the leverage they were taking and the strategies they were having to employ, not necessarily feeling the need to do all sorts of creative derivative trades to harvest yield, and actually move to a much more consistent, less volatile investment. There's actually a behavioral study out there that looked at investors in the US as well as the Netherlands as an independent study, weirdly enough to choose the Netherlands, and asked how much of your money would you have in cash or risky assets at different level of interest rates. And what they found was there was a non-linear response. The lower interest rates were the you saw risk assets go up exponentially. And then as soon as interest rates got to the 3, 4, 5% level, you saw a much, much lower theoretical allocation of risk assets. And so in terms of what could stop this liquidity cascades theme, you could say if rates remain relatively high, offer an interesting real yield, we'll have to see inflation continue to come down, that could break the link in this chain. Now, that said, we do continue to see a huge spike in derivatives volume, and we do continue to see the growth of passive. So neither of those trends have broken. So maybe it's not sufficient for what the Fed has done, but certainly at least one key point in the thesis of the liquidity cascades paper is no longer there. And that might stop sort of the flywheel of behavior.
Yeah, it makes a lot of sense. I think also with the Fed sort of taken its foot off of the pedal over the last couple of weeks here, what does that set us up for in the back half of 2023? Again, noting that we're talking today, 3 days into that back half. How do you envision this kind of shaping up, knowing that the Fed has maybe taken a little bit different tack in terms of its policy right now? What's your expectation? And again, knowing that nobody has the crystal ball, right? But I'm curious to hear what you think is going to happen.
This is a great time for this conversation for me because I'm smack dab in the middle of writing my Q2 commentary. And to me, the pithy title I would give 2023 so far is Revenge of the Zoomer. I mean, I was calling 2022 Revenge of the Boomer. Finally, the Dow Jones actually did something relative to the NASDAQ 100. And within 6 months, that has been entirely erased as risky stocks take off again. I think it's a really compare and contrast situation. What you saw last year was the market largely being led by the Fed, who said what they were going to do, but was going to be very data dependent about it. And so we had to wait as a market to see what the data came out. Was the Fed going to be true to their word? And there are incredibly material impacts in the real economy of those Fed decisions. Hiking 25 basis points doesn't matter. Hiking 400 basis points does when you talk about which projects are actually going to be built in the physical economy, the ability for a company to continue to refinance its debt. All of that stuff really matters. And so there's a profound knock-on effect. So it's not easy for the market to look across the chasm and say, we're going to get through this. Inflation will come back down. We should care about 15, 20-year cash flow and discount that. That's not easy because ultimately it's path dependent. Are these companies going to be able to stay in business? Is the Fed going to hike too much? Is inflation going to come down? Now that much of that is in the rear view mirror and the Fed is saying, hey, we're going to keep an eye on this, but we are stepping away. We're near potentially our last hike. And again, who cares about the last 25 basis points? I think the market has much more freedom to express its bets. And again, what you're seeing is you just saw Q1 GDP get revised upwards. There's a lot less fear about a hard landing, or if there is a harder landing coming, it's now been pushed potentially to Q1 or Q2 2024. Investors are much more willing to pile into those risk assets. And so I think that is what you might see continuing into the second half of the year. It's going to be much less like last year in that I think you're going to have much more violent rotations within stocks as things continue to reprice much more freely of Fed interference. Does that mean the market goes up? Does that mean the market goes down? I have no idea. But I think what you're going to see is a lot more freedom of movement.
Yeah, it's really interesting to think about how that freedom of movement will take shape. positioning that idea against what we talked about in the beginning of this conversation about passive investing, about kind of like the set it and forget it investing strategies versus let's mess around now because we might have until 6 months from now until we really feel the effects of what the Fed is doing, or the Fed's intentions kind of manifest. And I think it's interesting to consider those two approaches to how all of this shakes out, right? So yeah, I don't know. I guess the name of the game is to see what happens, but it's certainly interesting to hear your perspective on what that future might hold. So I appreciate you sharing all of this.
We have really diametrically opposed views in the market right now among very vocal participants. You have Ray Dalio continuing to come out, for example, talking about how it's going to be a real recession that's coming. You continue to see a very strongly inverted yield curve, and lots of people putting an emphasis on that as a sign that there is the bond market pricing in significant cuts that forecast a strong recession. And yet you continue to see the real economy numbers come out and blow that expectation out of the water. I think one of the things to think about is when you have two very diametrically opposed views in the market that are fighting for control, that's the type of environment when you can start to see very strong movement in both directions, because once one side capitulates, all that positioning changes and it gives a ton of freedom of movement for the other direction. So my only forecast is if there is movement in the second half, I think it's not going to be sideways. I think we'll either see a very strong bull or a very strong bear.
All right. Well, we're going to have to check back in at the end of the year and see how it all shakes out. Corey, thank you so much for joining us on Leading Indicator. It's been so wonderful to hear your thoughts, hear a little bit more about your thesis, and to consider what comes next. So thank you so much for your time.
Thank you for having me, Kinsey.
Of course. That was Corey Hoffstein, CIO of Newfound Research. I'm Kinsey Grant. This is Leading Indicator, and thank you so much for listening. See you next time.